Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 4 of the best Vanguard ETFs that will help you build wealth over the longer term. Vanguard is one of the top asset management firms in the world, and they currently have over $8 trillion of assets under management. They have a large variety of different ETF products that come with a very minimal expense ratio that provide investors the opportunity to build a diversified portfolio of some of the strongest companies in the world. And in this video, we're going to take a look at 4 different ETFs that you can buy every single month to passively build wealth over the longer term. Each of the 4 funds we're going to go over have a different investing style. We have one that focuses on growth companies, another one that prioritizes value stocks, a diversified blended fund, as well as a dividend focused fund as well. So we have 4 different ETFs that have a lot of variety and can be used by any type of investor to suit their personal investing goals. But before we jump into that first ETF, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any investing news, and we track the progress of my personal stock portfolio that has now grown to $169,000. So please hit that like button and subscribe, and now we're going to jump straight in to the first Vanguard ETF we're taking a look at right now, and that is ticker MGK for Vanguard's Mega Cap Growth ETF. So this is a large index style ETF with a minimal expense ratio of only 0.07%, and this fund is focused on some of the largest companies in the world that are primarily growth companies. So this fund seeks a passive investment approach and provides a convenient way to get diversified exposure to the largest growth stocks in the US market. And why I selected this specific growth fund over all the other options on the market is because of the nature of its holdings. This fund focuses on the mega cap growth companies, so these are the brands worth over $100 billion that have strong balance sheets, generate positive net income, and growing cash flow year after year. So those are the strong signs you need from your investments during a time of rising interest rates. As you know, throughout 2022, our interest rates have went from record lows and have expanded at the fastest rate in history. So a lot of the small tech companies are growth names that rely on external financing in order to expand their operations. The companies who do not generate positive net income or cash flow just yet and rely on external debt in order to grow, these companies have taken a major hit throughout 2022 and have fallen by over 50, 60, 70%. If we take a look at ARK's Innovation ETF, which is primarily made up of these companies who are not yet cash flow positive and rely on debt in order to grow, this average of this fund has fallen by over 66% over the past 12 months. So they've taken an absolute hit. So if you're looking for growth companies in our current economical environment, where interest rates are at record highs and continue to grow at an expanding rate, going for the mega cap tech brands that have positive cash flow and continue to generate with the use of internal generated funds may be the best option. And now taking a look at the portfolio's composition, it's made up of 96 individual companies that have a median market cap at $428 billion, and these companies, although they're of mega cap size, are still growing their earnings at an astounding rate with average earnings growth of 28% annually, which is incredibly impressive. They have a PE ratio of 27 and currently post amazing return on equity with an average of over 35% across the 96 individual holdings. So overall, although these companies are of the mega cap nature, they still post some incredible growth numbers every single year. And if we take a look at the fund's historical performance, we can see just that. The 5-year average annual return is at just under 12%, and over the past 10 years, this fund has returned 13.93% on average over a 10-year period. And since the fund was created back in 2007, the fund has generated over 10% annual expansion, which is great growth for a passive ETF. And the top 10 holdings within the fund include Apple, Microsoft, Amazon, Google, Tesla, Visa, Nvidia, Home Depot, and MasterCard. And one thing I do want to note is that Apple and Microsoft make up a large chunk of this fund, and together you're getting around 30% of the fund's allocation just within these top 2 holdings. So make sure you're aware of that if you're looking at MGK as a potential investment for your portfolio. So this was the first Vanguard ETF we're going to go over, a mega cap growth player. So if you want to get some growth holdings within your portfolio, but you want to go with what I believe to be the safer option in the growth sector, these are the companies that have mega cap status, very large, strong operations, and generate positive cash flow and income every single quarter. Definitely an ETF worth taking a look at. And now we're going to transition into the second ETF. We're going to do kind of a complete reversal and go to a Vanguard value focused fund in ticker MGV. This ETF holds the largest value companies within the US market. These are the brands that may not be growing at 20 to 30% per year or may not be showing rapid expansion in their top line. These are the consistent household brands that generate revenue every single year consistently and grow it over the longer term. They're cash flow positive with high net income. These are the brands that have very sticky business models that have been operational for years and will continue to operate in the same way for decades going forward. And with this type of ETF, because the companies are not growing at the same speed, they're also trading at much lower valuations. And if we take a look at the portfolio composition, it's made up of 144 individual companies with a median market cap at $142 billion. And the average earnings growth across this fund is at 13.3%. So again, lower earnings growth, but also a much lower valuation, with the average PE ratio being only 16.3 and price to book at 2.7. So in comparison to MGK, the growth focused fund, they had earnings growth of 28%, but were also trading with a PE ratio of around 35. So a much lower PE ratio or much lower valuation for companies who are also growing earnings at a slower rate. Their return on equity is in the double digits as well at 15.2%. And if we take a look at the historical performance for this ETF, they've shown some strong results. The 5-year average growth rate is at 9.4%. The 10-year average growth rate is 11.85%, and since 2007 when the fund was created, it's returned an average annual rate of 7.73%. And if we take a look at the top sectors within this ETF, we have healthcare coming in at number 1 with 24.5% of the holdings, followed by financials at 19.3%, and then in third we have industrials making up 14% of the total fund's weight. And if we go over the top holdings, they include United Health Group, ExxonMobil, Johnson & Johnson, Berkshire Hathaway, JP Morgan Chase, Procter & Gamble, Chevron, Eli Lilly, Pfizer, and AbbVie, so some very well-established brands within the top 10 holdings. So MGV was the second Vanguard ETF we're going to take a look at in this episode. You can currently pick up a share of the value fund for $106 on the market. And now if we continue on into the third ETF, it is ticker VYM for Vanguard's high dividend ETF. So of course we've taken a look at a growth fund, a value payer, and now we're on to the dividend fund for those income-focused investors. So when you buy into a high dividend ETF, you have to be aware you're purchasing companies who have above average dividend yields, but that also comes with the potential for underperformance over the long term. So if you're looking for some high current income, be aware you may be giving up 1 to 2% annually over the long term in terms of total return on the market. So this ETF is focused for investors who need that current cash flow into their portfolio right now. It's made up of 442 individual companies with a median market cap at $131 billion, and they post average earnings growth of 11.1%. This fund currently trades with a forward PE ratio of only 14.3 and a minimal price to book ratio of 2.6 and return on equity of 15.1%. Overall, this fund has performed very well over the long term. The 5-year historical average is at 8.6%. The 10-year average is 11.29%. And since the fund was created back in 2006, the average annual return is at 8.12% per year. And taking a look at the top holdings within this ETF, pretty similar to the value fund overall, we have ExxonMobil, Johnson & Johnson, JP Morgan Chase, Chevron, Procter & Gamble, Home Depot, Eli Lilly, Pfizer, AbbVie, and Merck. And overall, one thing I like about VYM is because it splits all the holdings pretty much individually across the entire fund. The largest individual holding only makes up 3.3% of the assets under management, and we can see overall the top 10 are pretty much even, other than the last ones coming in at 1.8. So you're not pretty much top heavy only in 1, 2, or 3 holdings like we saw with the growth fund, which had 30% in the top 2 stocks only. So ticker VYM is definitely another one we're taking a look at, has a current yield just below 3% for investors seeking the current income into their portfolios. And now we're going to move on to the fourth and final Vanguard ETF for this video, and it is ticker VTI for Vanguard's Total Stock Market ETF. This fund owns every stock in the US market, all the large and small cap companies. So with this investment, this is considered the only fund you ever need. To take the most passive investment style there is to buy VTI every month into your account, fund it from every single paycheck, and never look at it ever again. VTI owns the entire stock market, so on average you're going to receive the return of the total market over the long term, which historically has been very strong. So VTI is considered one of the best funds and probably the only fund you ever need to invest in throughout your entire investment process. So currently, if we take a look, there's over 4,000 companies within this ETF. The median market cap is at 117 billion. The average earnings growth is at 19.3%. The PE ratio is 18.5, with return on equity at just over 19% for the overall market. And the fund total assets within this ETF is at $1.2 trillion. This fund is absolutely massive and one of the most popular ETFs in the world right now because of the simplified approach to investing. You can contribute every month to this holding and never even look at your portfolio. Taking a look at the historical returns, the 5-year average is at 9.8%. The 10 years at 12.4%, and since 2001 when the fund is created, it grows on average by 7.63% per year. So if you're looking for the most simplified long-term investment strategy, VTI may be just that. So overall, this was the fourth and final ETF we're going to take a look at. Not much to explain with VTI, it holds the entire US market. So overall, those were 4 of the top Vanguard ETFs you can purchase on the market right now. With the increasing interest rates and the economic uncertainty, you may be focusing on the mega cap companies or the large cap names who have strong operations and can kind of weather the storm going forward, instead of the smaller cap companies who may come with potentially higher returns, but also have a lot more associated risk. So overall, the Vanguard Mega Cap Tech Company ETF, the mega cap value names, the high dividend payers, or even the total stock market ETF are definitely some of Vanguard's top options for investors all around the world to take a look at. So thank you for watching this video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.